We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Francis Hunt, CMT in technical analysis and founder of themarketsniper.com. Thanks for joining me today, Francis.
Delighted to be back with you, Tom. Thanks for having me on again.
Happy to be able to chat with you and reconnect a little bit and get some of your calls and update some of them here. So why don't we start by defining one of your kind of trademarked terms of hyper stagflation and how that ties into the euro spill and dollar dominance and strength here.
Oh, absolutely. Yes. So we're the only one using that phrase, but it is something we think that best categorizes the unique set of circumstances that have been manufactured by the central banking cartels of the world, of which the Fed is probably the most dominant player. Hyperstagflation is the following, and I do feel so I'm a bit of a doomsday prophet nowadays, and it's not by persuasion. This is not I'm just trying to misery porn everybody out, or I'm particularly negative person as a guy. People coming across me the first time, I'm actually quite optimistic. Our businesses have done well. I'd like to think that I consider myself as reasonably successful. So if I speak like this, it's because it's my true assessment, and I'm regularly checking my own self-awareness that I'm not just unnecessarily bearish, but the set of circumstances are uniquely bad. And what we essentially have is we have the inverse Greenspan Goldilocks economy. During a period where we had globalization, I was exceedingly bullish. I got into property. I ran a property company. I felt we were going to have sustained low interest rates. I felt that was going to be very aggressive for asset classes. We bought wholesale property developments on site from developers. They got better terms from their banks on account that it was pre-sold and that was not spec development. We packaged these up for landlords, so I rode the other half of this cycle, which was the Greenspan Goldilocks cycle. And I went into a UK in and around 99, 2000, where everyone was telling me, don't get into property. We had the most awful crash, 88, 89 into the early 90s. And I said, you're so wrong. Actually, it's going to surge again. And they were like, no. We had property crashes. We had 16%. That, of course, was the pound, George Soros event and the breaking of the pound when they tried to defend the pound with rates. So that was an incredible era. And I said, no, this is about the Fed now and globalization. And what that allowed, Alan Greenspan said there's no inflation. We've killed inflation. There were Time magazine, Newsweek magazine, is inflation permanently dead? The productivity miracle. They were selling you all sorts of baloney stories. Basically, what was happening is we had exported manufacture and workshops to little children in India to sew Nike shoes and footballs together, and China and various other aspects where normal labor practices in the US, which required certain minimum standards and higher labor costs, were no longer applied. So with this outsourcing, we ended up getting the global consumer of good. And I find I'm doing a lot of explaining of this, but the US is essentially a consumer-based economy. It won't come as a shock. That doesn't mean you don't export things and you don't have IP like Apple and various other things, but you're a net importer of goods. And there are other nations that are largely producer nations. So this is a simplification. And during this period, we outsourced and said, hey, we've got this much bigger world that we can supply. Pittsburgh used to make steel, hence the football team. But now steel is made elsewhere in much bigger ways. All those unionized, very blue-collar jobs disappear. So that got outsourced a great deal. And other parts of the world were doing this cheaper and in some cases more efficiently and more effectively. So what you were getting was better product, cheaper, that was shipped in. And you had a dominant currency. So it was all things good. And this was the Goldilocks economy that Greenspan gave us. And he said, therefore, there's no inflation. Therefore, he kept interest rates particularly low because it wasn't a great, in his eyes, a massive blunder in our word. He should have been biased significantly more tight. He was a big liquidity experiment guy. And he put the rest of the central bankers on a path that couldn't be turned, in my opinion. He came into 1987, he took over from Volcker, and he picked up the 1987 crash, which was the beginning of my investment career, really. I was a lot younger man then. And anyway, so that is the the Goldilocks, and what we're in is inverse Goldilocks. Now we are choosing to deglobalize, which means onshoring has to come back. Half the nations that we would have received items from, we're no longer allowed to, per se. So you have Russia being forced into China's arms by American policy, the SWIFT system not being deemed reliable for Russians anymore. You're almost forcing them to establish other paths if they weren't already doing so, which they were. You're encouraging yuan and ruble trade between them. So we're having a fragmentation. So what that means is you're deglobalizing, you're contracting your sources. It's costing more in an environment now where interest rates have to climb because the costs are being pushed on, and this has led to inflation plus the responses of March of 2020. Let's remind everybody, we're the only people that saw that coming in calling for single-digit oil, which essentially was the switching off of all SMEs globally, virtually, and the locking down of most people. And apart from oligarchical monopolist businesses that were transnational, like Amazon, etc., they did amazingly. Everybody else did terribly. So much so that the beginning of the concept of stimulus, which is essentially stimmy checks, which was essentially the beginning of a UBI trial for a period that many people don't notice, which is someplace they want to take us all, which is why, again, given if you understand where they want to take us into a UBI-based world, you understand that they have to flatten your wealth immensely out so that you are a needer thereof. Because actually, most people are quite happy to be self-reliant, earn their own money, and build their own wealth and have as little government in their life. But to get people to accept government in their life, they have to do it out of necessity, hence the problem reaction and the solution. So hyper-stagflation is the inverse Goldilocks era that is now being enforced on us, that was created by the pump of Greenspan and the subsequent dump that Jay Powell's having to find himself managing. And what he's doing is he's punishing or preempting the establishment of other monetary systems that are rivaling the dollar by creating an immense wave of dollar strength. He's not fighting inflation. That's a secondary fact. That's like copper miners that pull out silver. They're going into the ground for the copper. They're getting a bit of beneficial value that they can sell as narrative, and they're taking it out the ground while they're down there. But it's a secondary product. What he's actually doing is establishing dollar dominance through the Fed, having this much tighter set of circumstances that they are throwing down, that the Eurozone can't live with, that the Japanese are already doing yield control. In other words, trying to hold up their debt values by still doing monetization of debt. He's committed recently to quantitative tightening in June month, which is, as I say, not very far away. And that's going to be taking off 100 billion, 95 to 100 billion a time. Over a course of a year, you're looking at 1.2 trillion taken out of the system in terms of liquidity. That is the inverse of the CARE 7 trillion that was pumped in per year, taking out 1.2 trillion. In my opinion, things will break and go pretty bad a lot sooner than that. Then you have all these developments on the supply chain where China, I think, this is how the global macro is playing out. We'll tie this to metals in a minute, but you need to almost understand the chess game. Mm-hmm. China has done incredibly draconian lockdowns, and there's all sorts of ships that are being blocked in ports. The thing that China will not want to lose, as they witness America killing their consumer, and forget all you hear. I laugh every time I hear Jay Powell, the incredibly strong labor market. No, it's not incredibly strong. Nobody wants barely above minimum wage jobs. No one's going to show up for them. They'll live with their families and not work at all and watch Netflix and game rather than do barely above minimum wage jobs. Because if you look at the earnings, the growth rates in the earnings, it's very low actually, and always comes in unders on their non-farm payroll numbers. So it's more a case of people refusing to work if that's the work, because they can sit at home and do nothing and probably have a better standard of life than committing so many hours and it's a bad trade. In short, the labor market at the bottom end is just not attractive to get people to work. We've already got one of the lowest participation rates ever since, I think you have to go back to the 30s when in the males, because obviously there was a big revolution that brought women into the marketplace where the participation rate of males is so low. It was literally the Great Depression. So this is the paradox. So China wanting to retain pricing power is actually constraining supply. So you have your demand curve being killed by the Fed because the US consumer is the consumer of last resort. So the Triffin's dilemma is America exports dollars and imports product from China, Samsung from South Korea, Toyotas from Japan, et cetera, et cetera. So they get physical products. That's what you get as the great currency holder. You have to provide your currency offshore so that those people can buy oil and everything else in the dollar price mechanism. What's now happening is Jay Powell is engineering a dollar Dixie bull run, which we've explained, on account of putting up walls to the establishment of any new currency. Because what ends up happening if you're an African nation and you're hearing about, this other system that's being developed, but all these other currencies are relatively being killed and the dollar is showing strength, it actually creates a kind of FOMO and momentum that says, I'll still stay rather with the old established ruler and king, especially when he's in a strong cycle, because it's actually been the best investment recently. When you consider stocks, how they performed so far this year, has one of the best. I won't say it's 100% the best, is actually cash notes or cash holdings in the bank, assuming you trust the banking system not to go down with them hands, knees, and shoulders at some point. But I would say physical cash is a smart holding for emergency needs. So I'm quite dystopian in terms of what I see coming in the second half of this year. And I'd love to set a low bar and to be hopelessly wrong and for some things to turn out a whole bunch better. So I'm all good with that. And, if people want to come back and say, hey, it didn't turn out so bad, I'll be glad to be wrong on that. I will plan for my base case scenario, which is pretty bearish. And hyper stagflation means consumer death in America, which means reduced dollar flow offshore international. This is where a lot of people get the dollar dominance story. How can it be the dollar's too indebted to this? Why are you pumping the dollar? And it's a fiat and it's a nasty tool. No, I'm not. I'm just telling you what I'm seeing. What is actually happening is the dollar strength is also driven by the demand for dollars offshore that is requiring steady supply. And don't forget, in a debt-based system where there is interest, you always need more dollars. It's like burning petrol for your car. It gets consumed because you've got to pay the payment and interest on new money. So there has to be a perpetual expansion. Now you're raising the interest rates on dollars. That means those interest payments are larger and you need more dollar supply offshore to service dollar-based debt. So actually the demand for dollars is getting higher on an escalating interest rate offshore. Remember this. These people are being starved of dollars and need it. Now your consumer is being killed and is not buying a Toyota in Japanese yen and sending dollars over there. He's not buying a Samsung device and sending and exchanging Korean wons for dollars. Those dollars are not going off to those nation states. What you're seeing is we have technical setups. USD Korean won, USD JPY. You've had a 7 sigma move on the USD JPY. That we called for 136 when it was at 107s. And now it sits at 128. And people were like, really? You're calling nearly 30% move? Well, you've done 25% of that move now. And let me say, we also expect overperformance. So what is actually going to happen as a result of Fed policies is you're getting divergence of central bank interest rates policy. The euro is getting squeezed because it's one of the binary alternatives. Regularly, when I've shown up with you, I've spoken of the seesaw with the euro on one side and the dollar. Generally, euro up, dollar down, dollar up, euro down. So in terms of the Western world, your treasury systems are big multinationals because we don't set the price with our little holiday to Italy or my holiday to the US. The big treasury oligopolies do, where they're managing currency. They're going to take the view, look, this guy's going up. We don't want to sit with too many euros. So the net effect of what's going on in America is they will slow the rate of increase on inflation. By the way, they're going to start referring to peak inflation and it'll be like the new transitory. It's not going to happen. It's not peak inflation. As long as oil is sitting at 113, they might stop it from going higher. They may have occasional periods where it comes a little bit down. But the biggest problem is by pushing the dollar up and killing the consumer, they will restrain the inflationary growth to some degree, more than other nations. And that problem exports, instead of the dollars that they should be exporting, will export the inflation problem to the other nations because they will force a recession in America and Europe buying things in dollars. I'll find the euro. We've called for sub-parity. We've called for 95 to be run, 95 cents, many things. And as I mentioned, when the euro launched, the dollar almost beat its chest to remind the euro who was boss. The euro fell to 80 cents. So when new things are coming, the dollar likes to show it's strong and its dominance. It's almost, as I say, a chief silverback in the jungle there. It stands up and everyone else will submit like this. The new guy in the room that is not a threat. And in essence, we're going through that. We're going to go through a similar process right here. That means inflation is exported to Euroland and the East, because some of the biggest producers and the biggest population, in fact, you can do a circle around China and Indonesia, and you've got, more than 50% of the global population right there with an element. The Eastern currencies are going to get hit. We've got technical setups. The Hong Kong dollar peg, I think, is going to fail. We're talking about unbelievable. We function in the crypto markets as well, but we are macro. And I've been saying to crypto guys, it's not going to be looking great. You're not going to get your pumpamentals. And the new crypto markets are actually the FX markets. And that's exactly what we're seeing. And it's a dollar dominance trade. Everything is Dixie up. Now, there is a pause happening right now on the Dixie, and I'll highlight this. So we will, if you could run out and put this trade on straight away and think it's advisory, you're making a mistake. I just want to illustrate that nothing goes up in straight lines, but we have been exceedingly dominant. There is a little bit of a technical minor pause here. You went up to 105, you touched it. It's so typical of technical analysis for a key level just to be run on a wick level. The minute you ran the 105, smackdown of some degree. And also I'd say technically, this isn't a great technical. So what could happen is you could consolidate here for a bit, and then you could set up, and then you could go again to the upside. So if you rush and act on what I've just said right now, you've got to remember, we've been in this trade since 94.5. When we called this inverted head and shoulder. Here's the right shoulder, by the way, and that breakout. And even still, we had a period of churn there, and everyone was like, where's your dollar dominance? You talk on Twitter, everybody loves to tell you how stupid you are. Where's your dollar dominance now, and all of this? Because we were in sideways here for quite an extended period. You were back end of November, and you only properly started to run again in March, and then you went up, and then you went straight into another bull flag. But since then, since the April period, and the Fed declared policy, in a very short month, literally during the period of April, you've run to 104 from at one point being at 99. Now, that doesn't sound like big numbers, but that's been a huge collapse in the yen. That's seen the euro move to lows. And these are the components of the dollar index. The euro is the predominant part. It's over 50%. It's 52%. Japanese yen is around 13. And then you've got the pound at around 11. There's a little bit of Swiss franc in there as well, and other things, and even the Swedish krona, but they're minority elements. All those currencies are down against the dollar. This is a huge, huge move. And I want to reiterate, we've been on your program and we've shown this chart countless times. The macro dollar chart. And we said, this is a falling wedge. You are looking multi-decade. This is a monthly chart. This chart was put in front of everybody. And I'm starting to see folks copying our draw now and starting to get cotton on to what's happening now because we've shared it so many times. Let's get that month all the way in on the screen. This is your big macro falling wedge. You had the break from over here. This was the lows of 08. 08 suddenly saw a major rush into dollars. When there's fear and there's major contraction, great financial crisis, dollar gets bid. People don't understand that. You're going to force a recession on the American consumer, the consumer of world-based products. How do you not expect a dollar to get a bid? Every major time it's happened, dollar gets bid. The Shanghai gold crisis, when China was super indebted and everyone was worried how China was going to go, and they had the Shanghai Accord, 2016, dollar gets bid. Then you have this structure, which is technical continuation pattern. You've broken out. You're above the 100 level. Let me just also highlight this on the monthly charts. It's been ages, absolute ages. Let me just do a couple of months here. Maybe we can do 2 months. So this is going to be a real long-term chart. I just want to highlight here, this is a bi-monthly chart, that not since the 2002 were you any material length above 100. You literally had one candle here and then 2 candles straight back down in 2017. You had a wick as just before they announced the CARE 7 trillion and out. You didn't hold above 100. This is a clear break of the 100. This is how you break a new level and set new territory. The last time that happened that you're above that was this period of high. This falling wedge has triggered and broken, and you are in a channel upside of dollar dominance for a stage. That doesn't mean the dollar wins the game. It means the period of now is to be cash dollar long. Even though you're probably losing with inflation 8 or 9%, you're having a contraction in money supply. The value of bonds, this is the worst year in bonds, I think, in, I don't know, 3 decades. Call me a liar, I don't have the exact stats. I was reading it on Zero Hedge. It's absolute worst. If you're holding treasuries, you're going down far worse. You're going down in value in a period where your dollar's buying power is reducing at supposedly BLS 8% rate. In my opinion, shadow stats 16+% more closely. So we are having a contraction in money. This is a de-wealthing effect in the same way I was writing mass affluence reports for everyone in the UK on their property prices going up of the globalization era that Greenspan brought us from 1987 to the early 2000s pre the Great Crisis. So we had this mass affluence where just by owning a couple of homes, buying a buy-to-let somewhere, you could just ATM out cash and buy yourself a new car every 18 months. Cash, that was the great, now we're getting a contraction. The debt instruments are contracting. This was what we showed, and again, I've shown many times on this for guys that are regular viewers of your channel, and I hope there are many, and I hope they keep growing as they have been. But this was our yield discussion. Let's just show you this chart again. And I will just first initially take all the draws off. This was the capitulation, the final capitulation, log scale. This captures the 80s, the great gold boom. And since then, it's been bad, largely bad news for metals. And I think our time is coming again, because at the end of the day, this is you want to ask me about metals, but I keep talking about understanding the system. First, that's a log scale. When you put it on log scale, you can see the huge capitulation of 3 to 0.3. This was brutal, and the snapback. In terms of percentage change, this is the most vigorous dip and then reversal change in interest rates in the entire 40-year history. Technical analysis 101, and this is why I say we're the only grand macro technical guys, not the best. We're the only. A trend ends in a final capitulation. And that's exactly what you got on yields. So for everybody's understanding, bond values go up when the yields go down. So this was a blow-off top in bond valuation. Now you have a re-spike up. And why is it pausing here? We've got a little rest. Don't rush on and put these trades now, because we're talking at a seminal moment right now, because you've got back up to the key number of 3. Which is a relevant number on technical analysis and so many other levels. So we actually, let me just take that time frame off. This was a little inverted HVF. You can learn about HVF method, by the way, and how we make all of these technical calls on our marketsniper.com site. But this squeeze over here was a key collapse, essentially. And that's what we call a funnel. You were resisted and weren't allowed above 3% there. You were resisted and not allowed 3% there. And you had a macro huge spill. Guess what? That was the end of the bull market in bonds, or the bear market in yields. And now you're having a snapback in yields. Of course, you have a rest here at what was legacy resistance that has worked once in 2013 and again in 2018, when the economy was slowly warming up a little bit, that they could actually put up rates. And then you got your events of March 2020. The events of March 2020 was end of cycle for so many things. Yields, debt, a final capitulation in oil, now a net bull, all of these things. It was a seminal bookmarking event. You get those bookends almost that you put. That was a bookend for the debt trend, in my opinion. Such was the scale of money that was recreated. Everyone is saying, and 25% or 40% of the total money over 2 years was issued from all dollars ever in history. But they don't go look at the debt charts to see what that actually means. We run a debt-based system. They are talking about a reset through the World Economic Forum. Why is no one macro looking at the debt charts and saying we have turned on the bond market? Every market does eventually turn. We are continuation trader. I do not call turns quickly, but I am telling you, it is a turn. We were the first in July and August to call this turn. We had a first upside HVF. It's super overperformed. You should be short TLT. It will be paying you out of your nose, and you should be using those profits to stack gold and silver, in my opinion. So this is truly where we are in this. It is an end of debt system. To bring in the new system, they first got to kill the old horse for you to jump onto the new horse, and you are busy witnessing it. A debt-based system, failure in debt. Plus, you're seeing the release valves for those differentials in the central banks being driven through the FX markets. So the debt markets, which involve central banks and interest rate policy, release into FX. So you shouldn't see them as separate. Everyone will say, well, the FX market is bigger than the debt markets. Well, they feed into each other. One is a release valve for the other. So if I'm sitting with cash and I'm watching everything going down, where do I put it? Well, I'll be paid more interest in dollars, and the dollar's going up against my euros or my yen and everything else. What decision does a global oligarchical GE, Amazon do in terms of their treasury department? I'll sit with the dollars, thank you. That's what happens. And that's the current macro draw of where we are and what we're doing. The Fed is driving a dollar dominance policy, and they know it by virtue of a higher, more aggressive tightening and interest rate rising, and they will turn the pips a little bit more tightly than people realize till suddenly everybody gets it and rushes into dollars. You'll have a super spike in dollars. And we break the system on dollar strength, not dollar weakness. And that is my system. And that is why it's going to be hard initially for precious metals to get away. But the flippening event, as they like to say in the crypto world, is when you start to have, again, rushing gold and silver in the dollar markets. Then you're getting growth on growth, and it'll be first coming through gold. I've said a lot there in the macro sketch, so let me give you a chance to unpack and come back at me.
Yeah, I appreciate the I guess your ability to tie all those things together, Francis. Does the dollar strength really bring us to a new Bretton Woods moment when it just breaks every other currency?
I think so. So firstly, the notion that every nation state, if you think of who these transnational leaders are in IMF and all these other places that see themselves as some form of ruler of the world, they will think there's an unnecessary amount of currencies. I mean, does Guinea-Bissau and Senegal and let's say Outer Mongolia need their own distinct currency? So they think very much zonally, regionally, and a lot of things, plus power and dominance and centralization. Everybody's selling you a decentralized model, and not all I'm seeing is greater centralization, government involved in everything. This is the era of surveillance finance, without doubt, on a dystopian scale, and holding a physical bar and silver. And I think some people have highlighted to me that it might be a Perth Mint, or one of them is actually starting to offer metals with a chip in it. I would strongly suggest people avoid that. Off-grid money. This is totalitarian, power overlord, overreach times. You want to be as off-grid wealthy and as untracked on your physical wealth. You want to hold as much physically as you can. And you certainly want to do all these things. Bringing it back to the gold price, we saw this upside HVF over here, and we got everybody in on a little falling wedge there. This was during the oil collapse. We were looking at the relative value of gold to oil barrels. And so at the same time, as we said, that was the other half of the trade that most people forget. We said, go long gold, leverage long. We don't often go, we are leverage long gold. We are net investors on a blue pot, but we took leverage long on gold during this period while we were short on oil, and you went all the way up to the 2000 on this little upside HVF. And by the way, inside there is still a dip on the March 2020 events, and that's it. And it got shrugged straight off, and you went to 2000. And the even bigger and better setups were on the gold euro, which we had also been watching very closely, and the gold pound. Because the dollar had walked its own course. And I still have the draw on there for you. We expected gold euro 1677, you were getting long at 1100, and you were riding all the way in there. And in there is a monthly or a bi-monthly chart. This is a 2-month, each candle is 2 months. Is your COVID dip all the way up and back up to target? And in fact, we got a little squeeze higher, and we got out even higher. Same for the pound. Same structure. Let me take that number off. It's a bit big, but these are old charts of mine now. That was a call for 1506, and you were getting in at 990. You're getting in sub sub £1,000 for gold, and you were running it. And we literally sold the high there at 1575 on that. So that entire period was a gold long period. Now, what happens when you've made big structural upside HVFs, and HVF method is our bespoke method like this. I'll just show you it on the pound. I've got it in log scale here.
Francis, what does HVF stand for again?
The Hunt, which is my surname, volatility funnel trade setup. So what tends to happen is after you've made a target, the reason it's a target and a good place to get out is you get a pullback. And this is what's frustrated the metal people. They've been trying to go long during the news feeds of inflation into what was a pullback. But we have now, against the pound, reinflated quite nicely, and we're next to these legacy targets. So what we might be looking at, taking it to the charts for metals, and I'm intentionally going to other currencies apart from the dollar. I know your audience is American, but you have to bear in mind the dollar dominance that I've given you. Go and see what it's going to be doing against the other currencies first, because you might be able to see how much growth you're likely to get versus the dollar, even if you're US based. Because
that strength of the dollar is going to act against or as a headwind for the price of gold.
Correct. It's masking. But remember the rest of the world. Don't live in your bubble. Remember the rest of the world and see what is happening here. So if I look at this again, you got very, very close to the previous high. I'll just take all the annotations off. That high there on the pound, if I just hold it, was 1578. That's sterling to the ounce. 1578. The high on this one was 1580, it looks like. It looks like it traded actually a touch higher. Typically, when you get that kind of a move, we normally get another pullback of some degree, and you might get continuation structure. So you get a rest possibly, and then we go again. So you might get another macro HVF structure like the previous one, which saw big runs, but it's not yet ready. I'm not here to tell you what you want to hear. If you think it's going to moon now, I'm not that guy who's going to tell you that. I think you could gestate for a while. I think there's a fear trade at the moment. You're sitting. This is other very important key framing for people. There are two positionings for building wealth during these crazy times: the inflation trade and the fear trade. And you're pivoting between the two. And the fear trade is dollar strength. Remember the 08, I showed you the crash and then the dollar spike.
Because people want to jump out of risk assets into this quote unquote safety of the dollar.
Cash and dollar, correct. So that's your fear trade. So the fear trade is long the dollar against the yen, long the dollar against the euro, long the dollar against the Korean won, and many others. That's your fear trade. You can leave that on. Have your fear trade, because I think it's going to get uglier, a lot uglier still. I think the US indices are going to sell off further, even though people say, oh, it's cheap now, we've had a big correction, it's already 20%, blah, blah, blah. It's going to sell off a lot more. They're killing the consumer. Remember, the dollar strength is as much about killing the US consumer, because you stop buying the foreign goods. You stop exporting the dollar. They don't have the dollars they need to buy other dollar-priced products, even though it's not in your country. They might be buying dollar-priced products from another nation state, but it's priced in dollars. They need dollars to pay. Plus, they have dollar-based debt with new dollars needed to service interest as well as capital repayments. So this is the thing. This is going to lead to a super spike. And we've said many times before, you have a village of FX. And there's small little houses, poor houses, somewhere outside the main wall. And then you have the castle in the middle, which is the dollar. And as the horde comes, the Mongols are coming, the ones outside the wall get sacrificed first. Then you have the minor nations, the South African rand, the Turkish lira, just inside the wall. They get taken next once they breach the wall. And then there's ever more walls getting, and then the high priests and the kings are in the middle. What happens is as those die, actually, the money that used to be held there rushes into the best perceived option, the dollar. So you get a super spike in the middle, because it's a dynamic thing of pins. As these get pushed down, somewhere else it goes up, because there's a transference. That money isn't disappearing, it's just moving somewhere else. You don't kill energy. It just gets turned into heat and back into energy and all of that. You have potential energy, you have kinetic energy. You don't kill water. The shortage of water narrative is absolute nonsense. It turns into mist, goes into humidity, you condense it back down. You transfer it, you change its state. And it's the same with money, it's energy. Essentially, it moves elsewhere. And what happens is if you have a lot of peripheral states all deciding to move into one particular state, you get a super spike in that one. And the more you are spiking, when markets are destabilizing, you, instead of going towards the middle, you actually go to the extremes. Everyone dumps everything else and chases into the fear trade. So the fear trade is going to make you an immense amount of money. And if you're American, you're lucky it's the dollar dominance. And that's what they're doing. You're less lucky in terms of, as a consumer, your quality of life is going to go down. Your stock portfolio is going to go down. Your wealth and your property is going to go down because your rates are going up, and they're going to keep tightening quite some bit. And your debt and your bonds that are held in your pensions are going to go down. And you're going to have an inverse wealth effect that was the night that came with the day, the bright shining day that Alan Greenspan gave you in the Goldilocks economy, where he allowed rates to be too low and too massive, a new rating of asset price levels, where all PE levels and all things. You know, we've been crashing for a while. We are still higher by market cap in the stock market to GDP ratio than the peak of the dot-com boom.
That's a crazy
with
thought.
The current correction.
So you don't see a market melt up in the general equities coming, Francis?
So not at all. And I'm aware of this argument that's been made, and this is not a personal statement. I disagree, and I will tell you why. You've already had it. This is why I take you back to the March 2020 events. That was your melter. The market melt-up has already occurred. And these guys go, when I said, no, I disagree, this is that, they say, oh, I'd expect a technical analyst to say that. I'm a contrarian. Well, no, just open the chart. You should have seen your melt-up. How did you not see your melt-up has already come? You're behind the curve. That is the situation. For people that make that argument, they are behind the curve. Let me just show you a couple of examples of why you would say that, and I will show you with a chart why it is. And charts are the footprints in the sand, as I keep saying, of what people are actually doing. It represents the money. Browsing quickly here, let me find the indices. So let's start with the least aggressive, the Dow. So March 2020, you traded 18,149 low. They printed 7 trillion. How could you not see that being as inflationary and giving a blow off? You went from 18 to 37,000 in the space of 2 years, less than 2 years, 22 months. There's your blow off. What's 18 to 37? It's 100% blow off, and you missed it. And now, I would expect a technician not to see that. They don't, they voodoo scientists or whatever they think we are. The blow off is there. It was created. Now you have a head and shoulders, and now you've got a rate tightening cycle. Big, ugly left shoulder. Some will go, oh, your head and shoulders are really ugly. That's not a head and shoulders. It absolutely is. We deal in complex head and shoulders and indices where there's been lots of stimuluses. You absolutely will have a flat, low volatility left shoulder. You will then have quite a complex, high volatility head, and then you'll have a short, volatile up and down right. You have a target for the head and shoulder and a cycle end where it can go a lot longer. I've got a fib on here as well, which might be confusing some people, so I'll take it off. But in Elliott's theory, you have a down leg 1, you have a wee rally there 2, then you have the longest leg to come to the downside. You have had 1, 2, 3, 4, 5, 6, 7, 8 candles to the downside on the indices, and you're calling a blow off. And you're failing to see that they printed 7 trillion and you were at 18,000 and you topped out at 37,000, and 100% in less than 24 months, 22 months is not a blow off. Then you don't know what a blow off is. That was your blow off after a major capitulation. This was a flush out of all longs, forced sellers, and then a blow off. And that's the least spectacular of the indices. Let's do it the same thing again with the SPY.
Francis, before we move on here, what do you think about the possibility of the Fed reversing course and seeing something quote unquote break and reacting to that and starting to print again? How do you see that situation?
All of that's happening. Mm-hmm. I absolutely see all of that happening. The difference is people are calling for it too soon. Mm-hmm. They are making a point on dollar dominance. They are aware right now that people want anything but dollars. They just seized, I think, 500 billion in treasuries of the Russian system. Mm-hmm. They just canceled them from a financial system. It's obvious that even if they weren't before, which they clearly were, they would be absolutely accelerating, creating new financial rails that do not involve American banks, American clearing, dollar-based system. So that is accelerating like never before. You know it's coming. You know they're going to be doing nothing but working on it. He's pegged his currency. The ruble is now probably, as I've mentioned, the best backed currency, ironically. That's, I'm not saying it's well proliferated, everyone should go buy rubles just yet, but it's the best back. It has less debt, it has oil and gold behind it, and the money, as Kissinger said, is going east, and the system is going east, and the gold has gone east. So it ties to everything. It's going east, guys. But what does America do to a challenge? He fights first. What does he do? The only way he knows how. He comes out strong and tries to make the dollar attractive to everybody else as a holding class. And he kills the consumer that is keeping the other nation states' currencies up by importing their goods and sending dollars offshore. Can you see it? And that's how it works. Here's your blow off on the SPY. You were at 216, 217. You topped out at 480. People who don't look at macro charts don't see blow offs. That is in less than 21 months. How is that not a blow off? In percentage terms, 216, 217 to 480. You've done over 100%. That's on the SPY. When you get to the NASDAQ, crikey, Moses. This is a blow-off to end all blow-offs. You were down at the COVID lows at 6,637. 6,637. Bang. Where are you today? Over 16,000. How can you say we're awaiting a blow-off and not acknowledge that 7 trillion was the inflation, 7 trillion is the blow-off in asset classes, the economy is wrecked, it is an asset price re-rating to ridiculous valuation, and you've just had it. You have a huge head and shoulders here, left shoulder, long, weak, grinding upside head that fell out of the channel like you'd fall through a trapdoor, bounces on the 1275, small, volatile, up and down 750. You've had 1, 2, 3, 4, 5, 6, 7 weekly down candles. And you're still calling and waiting for a blow off, and you've got a triggering head and shoulder with a downside target of 9.2 and the likelihood of it being a cyclical turn in trend, a Fed tightening rates that they're going to push further. License to spill. Jay Powell. Jay, my name's Jay Powell, license to spill. He is going to keep going until it properly breaks. And beyond a little break, he's going to twist a little bit more this time, because he has to make a point for the dollar dominance. And the consumer is going to squeak. The supply chains are being sized down already by China because they can see it coming. They're trying to retain pricing power. So if someone's reducing that demand, you reduce the supply so that you don't lose pricing power. You're going to lose money, definitely. You're going to sell less volume, but you don't want to lose pricing power. You don't want to glut. That's what happened in oil, because America was importing 2 million barrels of oil. They went fracking license crazy under Obama. They became oil independent. That 2 million, you had Venezuela that needed to make the same revenue. You had Iran that needed to make the same revenue. You had Russia pumping and everyone wanting to make the same revenue. What did they do? They pumped more oil to get in the same money. That 2 million barrels caused a glut that everyone was pumping more oil to get in the same amount to keep their citizens happy because they do all the transfer payments and welfare. What did you have? You had a glut, you had a disorderly market, then you didn't have enough place to store it. It went negative on the futures because you didn't know where you could buy it and you'd have to put it anywhere. There was nowhere to put it. So
Francis, I did want to go back to that. How did you what positions or what structures were in place that made you call for that negative oil price?
Technical. Everything is driven technical. And why? People go, technical is wizardry. Technical is the footprints in the sand of real money moving it. The biggest players move markets. You don't as retail. You don't. You're a price taker. Even if you put a limit order a little bit under the spread, you're still basically a price taker. Who made that spread? The big guys, the oligarchs, the big corporations, and everything in every market. Technically, we saw it. So I will show you that oil chart and we'll come back to it. But I just wanted to make sure everyone understands the blow-off argument is a very dangerous argument in my view, because it is encouraging retail to be a buyer into a triggered head and shoulders and an interest rate tightening environment. Do not trade the stimulus until the stimulus is being called and the meetings are happening about saving the economy. It's going to come later than you think this time. Everyone counts on the Fed put until it isn't there. And believe you me, I've traded that with the euro Swiss franc when they walked from the peg. Everyone was going long euros with their back to the wall at 120 of the peg, and we went short. And then it trade 119.999, 119.997, and everyone realized they ain't there anymore. And then it just dropped. People were obliterated. They are not your friends. They do not work for you. Their words cannot be believed. They do what they think is expedient for the people that put them there, and you are not one of them. This is how the system works. This is a head and shoulders. Dip buying here is huge trouble. Wait till the pain is at its absolute maximum. There's not enough pain. Everyone is talking value. People still have a bit of money. You want to see despair and suicide, I'm afraid. And that's a horrible thing to say. I'm saying this with the darkest sense of humor, but you've got to feel the suicide in the market before you go in there. You've got to wait, and they will twist one more time with that knife. And then when they say, we've gone too far, it might be time to look at stimulus, we'll have a meeting about having a meeting about having a meeting. You can wait and wait. Don't be the first percentage. The market will still have to move up. You had a chance to buy here. You know, you could see this was a turn after a collapse. You don't have to try buy that low. You can buy in there and say, this looks for real. We're gaining momentum. Mm-hmm. Don't ever own the first 5% unless you've got an HVF and you understand HVF method and you understand risk management and you know where to place a stop. Be very, very careful about trading falling knives. And somebody is calling a falling knife by saying you've got a 50% blow off coming. You've had 100% blow off. It was called COVID. It was one of the single biggest macro events. How's it everybody's forgotten about that? How have they forgotten about the 7 trillion? How have they forgotten about the fact that the market was 6,000 and then is 16,000 in the matter of 20 months? That is your blow off. You're now in a head and shoulders. And they're going to keep tightening. So don't trade the stimulus trade until the stimulus talk is there. The stimulus talk is not there. This is not the noise they're making. We are going to kill inflation. What they're really doing is pumping the dollar. They know it. I know it. Everybody else thinks that he is saving inflation. To the oil question that you asked, again, it's technical. So if we go to the technicals, USD WTI, this is where we were when the oil trade was coming around. And I'm going to just take the spike out. I have to go out of log scale because it was such a ridiculous sell-off. We were here. We were here. And they were doing everything in their power. Everything I saw told me that we were right and was confirming. By the way, it was the second macro short that we called on oil. We were involved in the original Ukraine war when it went up only that much on the announcements of hostilities, Crimea, Odessa, and all of that. That was a structure as well. We called a break there. And then I later saw on CNBC, this hedge fund, the first to call oil short at $93. I was like, what? We were short at 105. Mm-hmm. What are you talking about? It kept going, it kept going, it kept going. This gave a macro falling wedge. And this was our basing ascending grind line, part of HVF theory. This was a very low, weak second impulse to this high over here. This was showing every little bit of weakness. Then there was a drone strike in Aramco in Saudi, and all that, they did a little push. They actually ran us out. We had a technical stop and we put the trade back on there. It was an attempt to put some heat back into the oil market. And guess what was happening? Aramco went public and offered all its shares to Saudi. The benevolent Saudis giving their citizens an opportunity to invest in the wealth of the nation. How kind. These are the people that behead men for debt problems. They put bury women up in the ground with their heads sticking out the ground and stone them for teenage pregnancies. This benevolent society was now wanting to share them wealth. No, they were looking for a patsy to hold their big bag holders in what they knew was coming. And this came down, down, down. Russia said, we can survive with very low oil prices. Let's go it. Let's do it. You want to have a slugging match? We'll have a slugging match. Down, down, down she went, and you had an absolute capitulation. It was technical. It was all within a macro falling wedge that we had drawn. We'd drawn all of this. And then we said, this is a falling wedge that's going to have a pump to the upside. And we swung. Mm-hmm. And there it is. It went even further, I have to say, than we thought. We said single digits. You got naught technically in the cash markets. And as I say, in the futures, you got negative. That was the trade to annual trades. We were short. Plains All American, which is a pipeline. It ran from $26 to $3. How's that for a market cap decimation? We took the trade out of that. I have all the trade records. I shared them on Twitter before. When people say, you didn't really. No, we did. And I have a community full of people who did with us. We traded the oil. We were short in and around here at about the 57s after it fell through the 60 handle, and it went literally to zero. And then once we turned, we said, this is going to turn into a massive pumpamental. How do you get a major? As much as the market reacts with a capitulation to the downside, so you get a macro force to the opposite side. It's natural, it's geometry. Technical analysis is geometry. The fear and the loathing, the more weak and the more loathing you get to the downside, the harder the pump to the upside. It's absolute technical analysis 101. You threw it out of that rising wedge and you're now in a major bull market and you're well above 100 levels. And we are not seeing sustained period under 100 levels again in ages. We've got a $250 target in time, but that won't be the same dollar you think it is. And that's going to then by all intents and purpose, we may have to measure it to see if that forecast ever comes across in Wokus for whatever financial system will be in existence by then. Because people don't realize, oh, when's reset? They don't even realize they're watching it unfold on them. The debt system has to die. The old horse must die to get all the lazy, inertia-ridden citizens off the old horse onto the new horse. That will be this dystopian UBI, surveillance finance, central bank digital token planned excursion that they've got going for you. So back to, I suppose, gold and silver. What's happening in this dollar environment? It's going to be headwinds. But if you keep an eye on gold against the other currencies, it's doing great. Mm-hmm. For the rest of the world, it's doing great, and it will end up doing great for Americans too. This is gold against the yen. How's that for a chart? Don't be too miserable. It's doing what it should indeed be doing. Here's gold against the GBP. It was recently touching very close highs. I think a small rest back, and then we go again. It's doing what it's supposed to be doing against most currencies. New highs against the euro despite the run. No new highs on dollar yet because of euro weakness. But every fiat gets a chance to fail, and in the end, it's the dollar, and it will fail. Then you will see all your growth as an American coming near the end. But it's already happening for Europeans. Europeans in gold are doing just fine. Brits in gold doing just fine. Japanese in gold doing just fine. Of course, they might have had a slightly better ride if they were holding dollars as well for now, but not too much. They're in the right place for the future. Your investment strategy of being long gold is right for the future. I think we form a continuation structure and we will go higher in time, but I think there could be a lot more ups and downs. You could be unlucky and run this, then it'll just be a bull flag like that. So let me just tidy that up. If we have such acute depression that I think is possible, I'm not saying it has to happen, but if we have a real turn the screw, kill the US consumer, starve the rest of the world of dollars, blow off in dollar strength, it'll be on very hyper stagflation returns. So you'll be in depressional levels of growth. There'll be very little bit of consumer spending. Assets will be contracting rapidly. Debt is contracting. Most things are contracting. That is why cash will be king. People should hold cash as well, and not just cash in a bank, cash on hand. The possibility for people that are holding cash in bank to get hacked is high. Hold cash notes. They will serve a final purpose in the event of anything unput. You could do this. Some people are already drawing that on silver. Silver will follow gold, and it will be the second half major runner, and it will just blast past everything when that happens. But gold's got a lead, and unfortunately, the gold-silver ratio is currently going the other way. But this technically could also be flags. But if gold dips a little lower, we can still go a bit lower on silver. But the time is coming. And as I've said to you before, by the time gold and silver really start running on the exchanges in dollar terms as well, you must expect that they will truncate that from happening. They don't want the consumer seeing gold and silver as money. They will never let you have gold and silver as money because they can't print it. They can't proliferate it. They can't surveil you on it. They want you in digitalized tokens. You've got to understand where they want to take you to see that they can't let other things show that up. They need to show you the convenience, the speed, the fungibility. They'll be selling you all of these attributes. Crypto has come about literally as a potential on-ramp for the central bank digital token, whilst being sold as a libertarian tool that's seeing you escape the Fed. That is my personal opinion. Bitcoin might exist afterwards. It might not. A lot of things could happen. There's a lot of risk. I have some, but I wouldn't have too much in it. They could cancel it. They could make it, trivialize it, put lots of taxes on it, make it very expensive. They could do a lot of things, or it could be allowed to exist exactly as it is. But there's too many Bitcoin fixers, this kind of guys, that are New World Revolution, that think they've escaped the Federal Reserve. These guys are absolutely dominating crypto, and regulation is coming hands and all over the place. So, have a bit if it's speculative, but right now they've been killed. They've been killed relative even to the NASDAQ. So they've been treated as a high beta tech stock typically. So the altcoins are one of the last places we still see further downside there. So, it must sound like I'm just a huge bear. Let me tell you, we made money and I was long property when everyone else said never get into property. It's the big cycles you have to get right. And I'm quite high conviction, although I recognize it can always be wrong, that we've got this one right. Dollar dominance is not good. It's the fiat trade that will dominate. And when it rests, the things that'll go up are oil, uranium, and the energies, and a little bit of the commodities, agris as well, and to a degree, gold and silver will have little keep pace moves in the pullbacks. But I think the fiat trade is the dominance trade now, until the Fed says, okay, we've broken it, it's time for stimulus. Then you overweight the inflation trade and you back out of it and you close your fiat trades, which is the dollar dominance.
Do you still have further downside targets for Bitcoin, Francis?
There are a couple of possibilities. So if you have Bitcoin, we do the Crypto Sniper tool where we talk very exclusively crypto. We have downside inverted HVFs on a lot of alts. So the alt market is even more higher beta than Bitcoin. If I show you Bitcoin and the draws there, I've got to just bring this to a smaller time frame. So we were calling bearish. You might recall that we called gold bearish and silver bearish at this point. And in actual fact, both gold and Bitcoin got a little bleed out to the top. That was because on the FOMC, they didn't announce any tightening date and they did 0.25 rate hike. This is chasing 8%, starting from 0.25. Next FOMC came in, we come all the way back down before it. They announced June for tightening. They're taking, and that's almost more damaging. The tightening is almost more damaging because it's liquidity than the interest rate, and a half point. There's Bitcoin. So it's done worse than gold and silver to the downside. It touched 47 there, I think. No, 42. Is that 42 or 47? I think it's 47 and a half. Sorry, 47 and a half up there. And you find yourself down, you traded 26. That's brutal. Almost half its last high. So this is a bear flag. That bear flag goes to 12K. That's not a call by me. Bear flags are okay for targets. I don't base a trade just off a macro bear flag, but they can happen. That's this channel here that you fell out. There is also the blue head and shoulder that I'm highlighting now as well. So let me just tidy that up a little bit. There's a lot of lines for guys to see. I'll draw fat and in blue. This is, oops, let's change it to blue. Let's get a different color on there. So this is the neckline there. 42K was where everybody's calculated that attack on Luna and Terra occurred from. They were shorting and accumulating shorts on Bitcoin there at 42. We had that's already highlighted, and it's the neckline of our head and shoulder here. This neckline of the head and shoulder gives a 15K downside target. That's horrible. It's more downside. It's horrible. It's more downside if it were to happen. There is a slightly more bullish, less bearish, let me say, opportunity or possibility technically. So there's a couple of scenarios and any one of these could happen. I think you're running the 15 if you were holding a gun to my head. I think you do that, and you might see the 12 as well. If this gets as extreme as what we've been discussing, people don't understand how people will be forced sellers of everything. There is one slightly less aggressive scenario. I'll just hide all the lines there. It's a bit intense, where you have a megaphone structure like that, and you trade down to around 21, and you then come back up, and then you break eventually long run when we go stimulus through the top of the megaphone, and it's a continuation. But that's a tough call with the current position of how the Feds are positioning themselves. It's a tough call, but this is more downside, and this would be the least, I'd see it 21, 22. I haven't drawn it perfectly there. I've just sketched it for you. And that's what we teach this. We're the only people that deal with this pattern. It's a descending megaphone on a bull pole. And typically, if that were to occur, you get continuation, because there was a reasonable amount of buyback there, but it's not holding very heavy. It's holding heavy since then. So it's not looking that great for me. So I would bias to further downside. By the way, we did call before all this happened that you would run those lows, and these lows. And we were bulls in the bull market period, both on that falling wedge and on that falling wedge. So we did put a big accumulation box on the crypto sniper. So a good track record there, saying that has been an accumulation zone, but the difference is this is a falling wedge into support on a bull market. That was a reversal falling wedge that will reverse back up into a second wave bull. This was a bear pattern, a bear flag on top of this. Sorry, let's just take that off. I wanted a line. This was a bear flag on top of that accumulation zone with a harsh selling leg. This is likely to run that. What typically happens is you always break a support zone with momentum, see that spill, and then you rally back into it before going lower further. So what was support turns into resistance, you rally back into it, and then you go down more. So most things point to more bearishness, which again says the stimulus ain't coming yet. They got to break it first.
So Francis, going back to gold, I know a lot of our listeners are very interested and probably quite invested in the gold and silver miners. How do you think they hold up, or do they get force sold along with the rest of the market, while let's say cash and gold hold some relative value?
I would encourage people to have a higher level of cash. Be careful on bank risk. There's counterparty risk is higher than it's ever been. I would be careful on bank risk. I would actually hold physical cash notes as much as you can get away with, and even have a safety deposit box nearby you that's not bank related, and have whole midnight gardening type story as you do for your gold generally. So I'd have a much bigger holding of cash right now. I think the opportunity to buy when everyone else is weak and broken is coming. There will be a proper, as I say, blood in the streets. I use the word suicide. It's a suicide season you're waiting for that will give you, and it's more than blood in the streets. We're talking every progressive federal central banks do not bring stability, they bring pump and dump schemes. And as they are getting to end of era, the pump and the dumps get ever larger. Essentially, COVID was, just think about what you went through. They stopped business. They destroyed global SMEs, and online macro corporations functioned only in a few essentials like Walmart, Amazon, etc. And in other countries outside of America, much harder lockdown criteria were enforced. You almost got it easy. You still could travel around in a very big country. Other people living in smaller lands, in apartments, were locked down, had cops arresting them, bullying them for going onto the beach, all sorts of mayhem. You're talking about one of the most extreme totalitarian health-based government acts. That is so extreme to generate the bigger dump. And each time that validated a 7 trillion pump. And America printed for the world, which is my point about not just printing dollars for America, but printing dollars for outside of America. And the dollar index had its down leg to those 89s, 90 lows where we said, right, it won't run that previous technical level. We're looking for reversal here because we had an HVF in mind for the Dixie, and we got in on the 94.5 on that inverted head and shoulder. And since then, you've been net long the dollar and it's been killing it. So, each successive crisis has got ever more grandiose in scale to introduce further controls and introduce you to further concepts. Whoever spoke of lockdowns before 2020? Whoever spoke of a government telling you can't leave your home before that? They are introducing extreme scenarios for introducing extreme control, power, and totalitarianism. This, unfortunately, is a dystopian pivot of the New World Order is already here. Don't ask when a new world order, when reset. It's already here. Mm-hmm. Your government is about to give health policy over to the World Health Organization and send your money to fund an unelected transnational global industry that's been receiving money from pharmaceutical oligarchical companies. Okay, so that's where you're at in terms of this beautiful world we're living in. And the only way, absolute power corrupts absolutely. And each successive crisis, a bigger crisis is needed to bring in more and deeper controls. So this is going to be deep and big. I'm sorry, I'm only for trend following, continuation of what people are trying to introduce. There is a logical reason for why I say it. I'm not the monkey throwing the dart at the board. I'm looking at the conduct of the people that are in charge and where we are heading. It's dystopian. It is totalitarian. It is dominance. It is government overreach while they're selling you decentralized crypto tokens. And you realize that nothing's decentralized. Everything's open to attack, as Luna found out in a very flawed model that used BTC as collateral in a dollar system at a technical point that Bitcoin was being hammered. That was destined to fail. The weak will be targeted and be picked off, and the money will be made. And if you think those hedge funds just did it, shorted BTC, that's alleged, so names that have been mentioned, and this is not an accusation, I have no evidence to them, BlackRock, Citadel, etc. These people are connected to the Fed. Do you think that's a round door, like the pharmacy and the FDA, the big pharma and FDA? These people change purses. They go work in the FDA, do the bidding of the industry, and then go cash out as a board member on one of the pharmaceutical companies. And the same with BlackRock. And where do you think the ex-Fed chairs? Where's Ben Bernanke? He's advisor to a hedge fund somewhere. So let's be clear about this. This is a corrupted system, hands down. Corrupted system. So these people are connected to the Fed. Do you think they shorted Bitcoin from 42 just because it's only going to go to 30K? No, that's not a big move. George Soros took the pound down more than that in percentage terms, and that was a currency. So let's be clear. There's more downside, and they're still short to some degree, at least I would imagine. It stands to reason, and they know what Fed policy is coming down the chute, and it's going to be more extreme than you're usually used to. Because they want to protect the dollar from these alternate systems. They want to drive any speculative hot money into the dollar and away from these new alternatives that the deglobalization and the war in Russia, Ukraine is causing. That's how I see it playing. Geopolitically, that's my geopolitical model. I think it's accurate. Everything I read continues to endorse it. I keep testing it. I look for new angles and new reasons. They are tightening for dollar strength. And it's going to kill your consumer, and you're going to stop importing. And that is going to cause currency issues and debt issues in the rest of the world. And you're going to watch it unfold, in my opinion. And there's going to be still very big moves. And the FX markets are now the new crypto markets, and the stock markets are the dumpermentals. We're hopelessly overvalued. That was sustained at valuation levels that was a generation of my investing career. That was super high on a buy the damn dip basis. Buy the damn dip is a meme, not an investment strategy. And its time will end. But you've had a central bank cartel that has supported that, specifically in America, that you have forward PEs. You have guys saying you should be buying tech now. We only had 10 times gross revenues. 10 times gross revenues, and you're not making a cent of profit. Mm-hmm. You can buy a Russian macro big business with a 1.5 PE. Price to earnings ratio, pumping oil in an undersupplied market where people can't get it in an inflationary environment.
And paying a yield.
And paying yield and paying dividend. Mm-hmm. That has been running for years, 30 years.
So Francis, when you think about, let's say, this whole reset system and what you can do about it, how do you think about, let's say, geographic diversification as a strategy around some of this as well?
I think everybody should have a 3-option geographic diversion strategy. I'm fortunate that the nature of my work dealing with this sees me speaking to people all the time, traveling all the time. So I'm in Panama now, I'll be somewhere else tomorrow. I have 3 destinations. Our community is discussing this all the time. I meet physically community members. I've just had, in fact, a couple are still here, sleeping in the bedrooms of our apartments. We've become good friends. We're supporting them getting set up in person. We've had an event with all community members come down here in Casco Vieja, the old town in the colonial greatest hotel, where we discussed all of this. We introduced partners, structures, everything. Everyone should have a reset strategy. You should pretend you're dead and you're getting a lease on life for 3 years. That's what I said about a year and a half ago. You get through that 3 years, you renew your lease. Manage mental strength a great deal. So be positive, exercise, keep fit. You were talking what great shape you are for the bike riding event. That's absolutely positive for you. It's positive for you mentally. You need endorphins. Jesus, drink mushroom tea, do whatever you need to do. Keep your spirit up. This is a psychological attack as much as it is a physical, practical attack. Restricting your freedom of movement is designed to reduce your mental fortitude and make you pliable to succumb to anything. You need to invoke your warrior spirit. You need to have options. You need to be arbitraging where there are gaps and you can disappear in the cracks, because this is overreach government. So we have 3 destinations. You need to get delocalized from urbanized environments into know your farmer, know your local police constable, because he's the guy that might have to do enforcement on insane laws so that he keeps rational. Someone who has a family in the area where you live. Know your constable, know your farmer, know your butcher, your baker, and your candlestick maker. This is to have space, self-reliant, borehole water, rainwater harvesting, definitely capture of water. The government's provision and parastatal utility provision is questionable. You could have grid down situations of all forms of grid, not just the mobile network and the internet network, power, water. You've got to go back to Maslow's hierarchy of needs and say the cycle is now about securing the base layer, for yourself and becoming, so this is prepper stories. And I'm afraid the prepper trend is right. They can make a mockery of them and make them all out to be rednecks on TV in some channel, one of the 57 channels and nothing on that you have in the States. But I'm telling you, that's for real. That's how they trivialize it. This is what you should be doing. Security, be able to secure your old security. Some of your concerns will be other people that haven't prepared. So I'm afraid there is a bit of bullets and ammo in that whole narrative. I don't think America has much of a problem with that. But you might find use stock ammo, like 9mm rounds and things like that. Be well loaded and let it be known that you protect your stuff. Then generally people won't mess. People will go where the weakest are, much like Terra Luna was attacked because it was clearly flawed. So just don't be shown to be weak. It's not a time to be flashy. And Lamborghinis and stuff like that. I would say it's better to be pragmatic, 4x4s, off-road. If you're a US, look at your tax structures. Look at having a corporation outside of America where you can open crypto accounts, capital gains, tax extraction. Once they've got you where they want you, they can pass any laws they want. Don't forget, inflation is here to impoverish you. It is an absolute impoverished tool. The only people who get richer in inflation are billionaires, because they sit with a huge debt where they've bought lots of assets, and the debt gets devalued and the assets that they've purchased continues to hold value in inflationary terms. Hence, Bill Gates buying farmland. That farmland will go up in value, at least at the rate of inflation. And if we get shortages of agriculture, even faster. If they squeeze the supply chain like that. So you want the middle class that have some debt and, but not super rich on stocks. Once the inflationary cycle and the stimulus comes back, you're going to be dragged into higher tax bands. You're going to have no protection. And let's just be clear, capital gains is a killer tax. We had a guy in crypto who made about 500,000 in the run up to 20K in 2017. And then he had a huge tax bill. He had to, by the time he had to pay it, Bitcoin was 3K. He had to sell all his Bitcoin and he still owned the taxman money. So, you've got to look at being within the law as efficient as possible. We've opened crypto accounts for corporations in Panama, where you essentially, unless you realize or try transfer out, and you create a capital gains event, you're largely tax-free. So there's lots of things you can do. I have links in South Africa. Unfortunately, South Africa and every government is largely captured by this World Health Organization, but it's farmer territory. It's very self-reliant. Look at the nation maps of who has all they need that grow internally, and check that out. And get local to farmers, get rural. You don't want too many people around you. You want reliable. Form community. with like-minded. This is what our entire site is about, community of like-minded people. We go and stay with these same people that are putting up here in our apartment when they come to Panama City in their beautiful home, and we swim in the river in the mountains in Panama. They've got hummingbirds drinking sugar water, and it's just beautiful. We have options, form allegiances, get local, like-minded people. Don't try to wake up sleepyheads. Leave them to rot and die. They're going to be part of the people that will be coming like zombies for your preparation and your tools. Mm-hmm. Talk little about it to those people, because that's just information they'll use against you later when they haven't prepared, when they come and try extract and beg and borrow. You've got to work with people that are taking action to defend themselves now in what is a dystopian future. Don't be waiting for a stock market melt up on a head and shoulders breakdown. It already happened by people who don't even open charts to look at the footprints in the sand. If it's hippo's footprints, I'm not telling you to run after it because they're telling you it's a honey badger. You're going to have a nasty shock at the end. The tracking of the money is the game of money. I start technically first, then I find out the fundamentals. If it's not technically interesting, I don't start. And the chart confirms everything. We've had an end to the debt system. We're in the process of watching a debt system die. Getting back up to 3% after falling to 0.3. That is 9/10 you lost and 9/10 you snap back. That is a capitulation. Everything to do with the COVID event is an economic event more than it was almost a health event. It was the end of the bond bull market. It was the final blow off in the equity market. Where did all that hot money go? You didn't get 7 trillion. Nobody sent me a check. I didn't go buy the NASDAQ stocks. Somebody else did. Mm-hmm. Somebody else got that money in grants, in loans, in what other form. But I can tell you a lot of that hot money ended up in the stock market at ridiculous valuations, expecting the inflation. And now you're going to get the deflation that's going with it. Because these guys are tightening policy. Until they start talking stimulus or that we've broken the economy and we've done too much, don't even go there. And it's going to get disorderly before they stop. It will have to get disorderly. The Fed put is going to arrive a lot later this time, in my view, in terms of where the markets will be. It could happen very soon, but a lot will have happened in that time. The pain is going to be higher. You're going to be tested. Every successive crisis is more extreme. Central banks introduce volatility, not stability. The volatility is how they take all the wealth from you. The inflation is a tax on the middle class and the working poor. And it is an enrichment tool for the billionaire class. Please understand these concepts, then you'll know the game.
Perfect, Francis. Of course, the community you talk about is available at themarketsniper.com. Is that right?
Yes, absolutely. Trading, investing, and building backup resources that are off-grid. That's a large part of what we do.
And of course, on Twitter at themarketsniper too. Francis, I really appreciate you sharing your thoughts and your charts with us. And I know it can sound kind of dark, but maybe this helps wake some people up to the ideas or the possibilities of what could be happening right under our noses, and watching the footprints in the sand, as you said, might be helpful for some people here.
I will say as a closing point, because I don't like leaving people down, the darker the day, the brighter the morning that follows. And for those that survive and prepare and are at full facilities and capabilities after a long, cold night, the more beautiful that day will be. Just see it for what it is, take action. Your life and your success in life is how you behave and perform at points of highest challenge, not when it's the big easy lying on a beach with a pina colada. It's all your most acute memories, all your best memories are under duress. In the army, carrying 55 kilograms of lead on my back, with a concrete block in my hands and an R4 rifle over my shoulder, sweating like gangbusters, doing 5-day route march up the biggest hills. All my best friendships, everything that was of value was forged in the heat of the furnace. And you are going to get an opportunity to forge this. It's character building stuff. May you live in interesting times. It is a curse. It's also a blessing. Real men stand up. Weak men fall. This is your time. Work on your mental health. Get physically fit. You do all these things and you will sail. You'll become a beacon of light. You'll find your meaning in life. You'll find your cause. You be up, stand up, be that Viking. Back, smash your axe against your shield. Get ready to rumble. And this is the game. Take it on. The obstacle is, in fact, the way. approach all your weaknesses and all your weak points, assess them and attack them. Go learn, go grow. You come out a bigger, greater man. Protect your family, protect your loved ones, and you will have many people at your funeral that will sing heartily and sing your praises for the contributions you made. You were born in these times. You don't have the option or the opportunity to determine them. You must decide what you make of them, and real men win in real times, and it's time to be a real man, and that includes obviously the feminine, with female leaders, everything as well. We want you all. We want everyone on the team. Wake up, be strong. You are defining yourself. These are your defining moments, and that is greatness. And you have greatness waiting at the door for you. Find like-minded people who raise you up, but you don't have to filter your conversations to not offend, and start building community. And you're welcome to come and have a chat with our guys.
Excellent. Francis, thanks so much for your time today. And
absolute pleasure. Thanks for having me on, as ever, Tom. Have a great one.
You too. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.